Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Thursday, February 26th. We are talking about Nvidia's big quarterly results today on the show. The company's business is accelerating, which is remarkable at its scale. We'll also talk about Salesforce and Snowflake's results. We'll then talk about the debt that big tech companies are raising and how their credit profiles are changing because of it. We'll also get to a scoop about a Kleiner Perkins-backed defense startup raising up to $1.5 billion. And we're going to end the show with a conversation about robotics data with the co-founders of Encord, a company that we broke some exclusive news about this morning. But I want to start the show today with a big story that we published late last night. As OpenAI brings together its massive $100 billion funding round, details are starting to emerge about the terms of the funding that some investors have agreed to. My colleague Sriman Pidi revealed some of the details of Amazon's proposed investment in OpenAI, and I want to bring her on to talk all about it. Sri, welcome back to the show. It's great to have you here.
Excited to be here.
What did we learn about Amazon's investment?
What we learn is that Amazon is investing up to $50 billion, but there is a condition. So the first tranche will be $15 billion as part of the round that OpenAI is raising now. And then the $35 billion second installment is actually conditioned on whether OpenAI achieves AGI, or artificial general intelligence, or if the company goes public. So that piece is quite new and different from what we had known before.
Why is Amazon hedging its bet here? I mean, does it not think that it's going to IPO? Is that still a question? We'll get to the definition of AGI in a second, too.
Totally. So my understanding is that essentially it is a opportunity for Amazon to gain more from its relationship from OpenAI if either of those conditions happens due to the exclusivity clause that Microsoft has with OpenAI. So Microsoft has been a longtime backer of OpenAI, has poured around 13 billion and has exclusivity rights to resell OpenAI's models, as well as actually take a 20% revenue share, which we've all reported before in our past reporting. But I think these clauses essentially allow Amazon to potentially gain more from its relationship. And so if, for example, OpenAI does achieve AGI, then it allows Amazon to gain beyond what this sort of existing ability it has now. So those are some of the reasons why Amazon is able to sort of have these conditions.
Now, the definition around AGI, is that any clearer than it was, say, 12 or 18 months ago when this whole discussion sort of came into vogue?
It's not exactly clear to me, but what we had previously reported back in 2024 was that AGI was basically if OpenAI generated 100 billion in profits, based on sort of our reporting on the company's financials in the past. OpenAI won't actually achieve that even until beyond 2030, and so my hunch is that the definition of AGI is likely changed, but I'm not sure. But what we do know is that whatever or whenever OpenAI defines that they've achieved AGI, they'll actually be verified by an expert panel separately. And so that sort of condition from the Microsoft OpenAI agreement still holds for its relationship with Amazon as well.
And we don't know who's on that panel yet, do we?
I don't believe so.
Well, that's gotta be a pretty fun panel to sit on. I mean, this is like I'm just thinking about the definition of AGI and how contested that is. I mean, these people really hold so much power, not just for this one deal, but I'm sure that will get scrutinized by everyone if it ever comes out about how, the criteria they were using. So that's kind of an interesting group. You also had some reporting about the cloud deals between OpenAI and Amazon. What do we know there?
Totally. So Amazon and OpenAI agreed to a cloud computing deal for OpenAI to purchase about $38 billion worth of cloud computing over the course of 7 years. What we reported last night is that cloud deal is going to expand much larger than that. And so we don't know the order of magnitude, but it's going to be a significant expansion. Other aspects of the deal is also around Amazon actually OpenAI powering Amazon's custom models. And so that could be for internal products that Amazon uses as well.
Okay, and last question for you. I mean, this is the relationship between Amazon and OpenAI and the terms of that relationship. Do we know anything about the other hyperscalers' investments or the other strategic investors and what terms they've agreed to?
We do have some new reporting about specifics around like the Nvidia deal. So the new piece is that we had reported previously that Nvidia would invest up to 30 billion. What we now learned is that it's actually going to be three installments of 10 billion over the course of the year, and that's very similar to the SoftBank investment, which is also 30 billion with 3 billion, or sorry, three installments of 10 billion over the course of the year as well.
Great. Well, Shri, I want to thank you for coming on. That is Shri Mupidi, our OpenAI and Anthropic reporter here at The Information. The big news this morning is how investors are reacting to Nvidia's results. Revenue grew 73%, a dramatic acceleration from last quarter. Net income nearly doubled. Joining me now to break down the results is Matt Bryson, Managing Director of Equity Research at Wedbush. Matt, welcome to TITV. It's great to have you here.
Yeah, it's awesome to be here, Akash.
What stood out to you from the results last night?
I I mean, as far as I could tell, it was all good news, right? As you said, revenues accelerated in the quarter. The guide was well above what anyone had on their bingo card. And you have to remember also with Nvidia that when they guide for 78 billion, they're really telling you that they think they can do closer to 80 billion because they leave a little bit of revenue in their back pocket. So from a results perspective, everything looked great.
And yet, shares are down this morning.
Yeah, it's really strange. I had conversations with multiple customers, talked with some other analysts. I don't think that anyone has a good explanation, at least fundamentally, as to why the stock's down. The reasons people talk to were all kind of concerns in the background heading into numbers. So things like can capex at the hyperscalers remain at these levels into 2027? Might there be a reset in NVIDIA's component costs when you get to next year? But none of these are new issues, right? These are all the kind of concerns that have been lingering for some time. We really won't have answers till we get to the end of this year.
What about the concerns around customer concentration? Is that something that you've been thinking about?
Not really. I mean, certainly they say 50% of the revenues come from large hyperscale customers, but that's the reality of IT spend in our world. Whether you're supplying memory or hard drives or in NVIDIA's case accelerators, those customers just are huge buyers, and you can't get away from that.
What about the margins? So the margins are kind of an interesting story here. Their gross margins are in the mid 70s in terms of percent. You compare that to AMD, some kind of the next best company. I mean, they're mid 50s. How sustainable do you think those margins are for Nvidia?
Yeah, so people say there's an NVIDIA tax, right? That effectively NVIDIA is able to charge more for their chips than anyone else, and it is a concern that if competition ratchets up, that at some point NVIDIA sees its gross margins come down. The question really is, so what does that competition look like? If you think about someone like AMD, Helios racks have to be competitive when they come out, and we just don't know yet, right? Helios is still a to be determined in my mind. If you're thinking about something more like custom ASICs, so what Google offers with its TPUs, or what Amazon's working on with Trainium, Meta and Microsoft have their own parts. Certainly, there's the potential for those products to be cheaper. At the same time, the concern with ASICs is that you are building them for specific workloads, and AI is a rapidly evolving beast. And so, do you pick the wrong workloads? Also, ASICs are hard, right? We've got one company that seems to be doing them very well in terms of Google, and a lot of companies that aren't doing as great a job. So, could there be competition? Maybe. Could NVIDIA suffer next year when what I believe are very favorable supply contracts, at least in a world where the backdrop is component prices are going up at crazy levels? When those contracts run out, could their margins be hit? Maybe. But again, we've always had concerns around what happens next year or the year after, and this is no different.
Now, talking about what happens next year or the year after, it feels like people have been talking less about the question of depreciation and what the right schedule is to depreciate these chips and how customers are thinking about replacing old chips with the new chips. I mean, as these chips get better, is there any reason to believe that customers won't replace old chips with new chips at all?
I mean, you always see some replacement, right? And if you think about the hyperscalers, they have 5 year, 6 year depreciation schedule. So there's an assumption that 5 years, 6 years is kind of usable life for servers. I think the concern had been that Nvidia was evolving so rapidly that that usable life was going to be shortened. We heard Colette on the call last night say H200s are being fully utilized as far as they can tell. So that tells you that uh, the customers are getting full use of these products, at least for their usable lives. And I would also say that in my own conversations, particularly smaller customers are still buying a lot of H200s, in part because they fit the power profile of some of these older data centers a whole lot better than the NVL72 systems. And so I think there's still a whole lot of demand for that generation. And if there's still demand and they're still getting use, then there's not a depreciation issue, at least yet.
You're talking about H200s, not the sales in China, but just H200s broadly.
I'm talking broadly US, Europe, that there are still buyers for H200s. Again, because some of the problems you run into NVL with NVL72, right? It draws a ton of power that some older data centers, they can't support that. And so you can put an H200 in, or a system with H200s in, and make money selling tokens. And so there are companies that are doing that, which tells you the H200 is still a very relevant part.
Now, speaking of the H200, did we get any clarity last night on the trade dynamics with China and what they're expecting there?
So Nvidia suggested that the U.S. administration is allowing a small number of exports to China, or has approved a small number of exports to China. That China, however, is not yet admitting H200s into that country. I think it's still a political negotiation. At some point, presuming there is some sort of result here. Nvidia could potentially see a pretty big boost to revenues if they can ship again. Having said that, they didn't guide for anything, and I don't think anyone's necessarily expecting anything yet, because it's just really hard to figure out what's going to be the end game politically.
I want to pivot very quickly. We were talking about AMD, and we saw the news also that AMD is buying a $150 million stake in Nutanix. Can you tell us what Nutanix is and what you made of this deal?
Yeah, so Nutanix is an HCI provider, so they
HCI, break that down for us. People aren't as
yeah,
technical.
yeah, no problem. So there, it's converged infrastructure, and so normally you've got discrete pieces of your data center, right? You've got a storage array, you've got a server, you've got networking equipment. What HCI does is it converges that stack. So I'm using one set of software, and it's managing both the storage in the server, as well as the compute. And so I don't have to think about managing these different entities, if you will, or manage or having multiple entities in my data center. I think from an AMD perspective, and I didn't look too closely at the deal, but that they are still a relatively smaller player in the enterprise, with their compute solutions, where they've done a great job penetrating hyperscalers, but less. They have less penetration in the enterprise still. This gives them a powerful partner to work with in terms of getting some more enterprise traction on the compute side, where I think they still have a huge advantage in server compute, given their ability to build and sell these really high core count CPUs.
So this for you is really a customer expansion strategy to get to those enterprise customers for AMD. That's how you're thinking about it.
Seeing the news headlines hit yesterday, that was my first thought.
Great. Well, Matt, I want to thank you for coming on. That is Matt Bryson from Wedbush here on TI TV. Salesforce and Snowflake also reported quarterly results last night. Salesforce grew revenue 12%, an acceleration from the last quarter, although that was aided in part by its acquisition of Informatica. Snowflake revenue grew 30%, an acceleration from last quarter. I want to bring on our financial analysis columnist, Anita Ramaswamy, to help us break down those results. Anita, welcome back to the show. It's great to have you here.
Always great to be here, Akash.
Another busy morning of earnings. So we had Snowflake and Salesforce last night, in addition to Nvidia. What stood out to you from the Salesforce and Snowflake results taken together?
Yeah, definitely a busy morning. And there's been a lot on software investors' minds in particular. I think that both of these stocks have been hit hard by the sort of negative sentiment around how AI is going to potentially disrupt the software sector. And so we saw both of their stocks after they reported earnings, despite earnings overall being good, trade down a little bit. They both since started correcting this morning. But I think that there's a divergence in how I see these two companies. And that fundamentally is because Snowflake is playing more at the infrastructure layer, where they're a company that helps other companies get their data in order to run AI workloads, whereas Salesforce is more so focused on the customer facing app. And I think that's most obviously reflected in the top line growth rate at the two. Like you mentioned, Akash, Snowflake is growing around 30% year over year. Salesforce is growing closer to 12% as of this quarter, which was actually their fastest growth rate in the last several years.
I want to ask you about how AI is affecting both these businesses differently. You kind of hinted at it here, but I'm going back to some comments that Martin Pierce wrote in his briefing newsletter last night. He wrote that Agent Force's ARR, for instance, is just about 1.7% of Salesforce's total fiscal 2027 projected revenue of about $46 billion. So, I mean, the story here, Agent Force is growing, but it's still a small part. Snowflake, like you said, it's an infrastructure layer. Maybe they're seeing a little bit more of a benefit. I mean, is the story different here?
I mean, there's some difference, but even with Snowflake, it's hard to tell exactly how much of their acceleration in revenue growth has been as a result of AI. They've disclosed the number of customers that they're seeing, and that seems to be growing really nicely. They also said this quarter at Snowflake that they signed their largest deal ever, which was around $400 million worth. And they attributed that at least partly to their AI suite. And so it seems like Snowflake is benefiting from selling AI products to customers. I thought one interesting point on Snowflake is that their free cash flow margin has actually gone from 43% a year ago to 61% in the latest quarter. So that kind of shows that even as they invest in AI, they have been able to continue to generate cash at a faster rate. I think with you both Snowflake and Salesforce, however, they're huge companies. And like you pointed out, the AI product, especially at Salesforce, is a pretty small portion of their overall revenue. So even though it's growing like over 100% year over year, we still don't really know how much of a meaningful catalyst that's going to be to top line growth going forward. And I think another, important point to note is that the acquisition of Informatica for Salesforce, which closed in November 2025, was a meaningful accelerant and driver of their growth. So I think it remains to be seen, Akash, whether the organic growth for both of these companies can continue. The one negative point on Snowflake that some investors were considering is that they gave their revenue guidance for their fiscal 2027, which their fiscal year ends in January. And Snowflake essentially implied that their revenue growth would decelerate to around 27%. Now, that's still a really fast growth rate for their product revenue, which is the majority of their top line, but it's slower than it was in previous quarters. And so that could be a sign that there is something more fundamental about AI that is challenging both of these businesses in a meaningful way.
Right. Anita, I want to pivot and talk about a story that you published today on other big tech companies, bigger tech companies, even than the Salesforces and the Snowflakes. You wrote about the hyperscalers, even the Metas of the world. It's funny, we don't call Meta a hyperscaler, and yet I still seem to conflate it with it. I know it's people are going to say don't conflate the two, and I'm not suggesting it, but it's kind of hard to talk not about
Yeah.
Meta in this conversation. Anyway, you wrote about these big tech companies and the debt that they're taking on and how it affects their credit profile. What were the questions that you went into this story with?
So I went into this story wondering about how all of these companies have issued debt in recent months. We saw two debt raises in November. We saw a debt raise more recently than that from specifically, I'm talking about Alphabet, Amazon, and Meta, which I guess one could argue if they really invest in Meta compute, maybe they will be a hyperscaler someday. But that's another conversation for another day. The question that I was really trying to answer with this piece is what will it take for these companies to actually see an increase in their cost of capital? You know, they're issuing more and more debt. It seems like they're continuing to plow more and more capex into their AI investments. And increasingly, that's being funded in the debt markets, not just the equity markets. And so I wanted to look at what the potential impact could be of, could they get downgraded by the credit rating agencies? Are they even anywhere close to reaching that point? And are there any other factors that could meaningfully increase their cost of capital for the long term?
And so what did you ultimately find?
So the good news for investors in these big tech companies is that it looks like a credit downgrade is pretty far off. The threshold for these companies is around 1 times debt to EBITDA, and all of them by the end of 2026, at least when I talk to S&P analysts, are projected to be closer to like below zero point 0.5 times, let's say, zero point 0.2, zero point 0.3 around there. And so they have a lot more capacity. I mean, each of these companies can take on about $200 billion in incremental debt as long as they generally meet the projected EBITDA that analysts expect them to make.
And when people are calculating these credit ratings, is it only the amount of debt that they have on their balance sheet that they take into consideration? What are the other factors that they consider as they're coming up with these ratings?
Yeah, so this is actually something interesting that I learned as I was reporting out this piece was talking to these credit analysts. They're not only taking into account the credit metrics, like, can the cash flow cover the debt and then what that is going to look like going forward, but also some strategic considerations in terms of the business. So if you take all three of these companies, Meta actually has the lowest credit rating of all of them. And that is largely a function, I've been told by these credit analysts, of the fact that their business is really dependent on advertising revenue, whereas the other two companies are better diversified. And so that sort of comes with a little bit more of incremental risk. In some of my conversations, these analysts were saying that they have this downgrade threshold of 1 times leverage, but that they could even potentially revisit that if these companies show depressed cash flows in the future. And so, of all three of the companies, I would say Meta is probably, looks the riskiest right now just based on their credit rating. And that's not just a function of their current cash flow and debt situation. It is very much a function of what the future of their business could look like and how analysts are perceiving that.
Now, the other piece that you wrote about that I found interesting is you talked to these analysts about how much demand there is for this debt and the fact that these companies are, I mean, these are blue chip tech companies. And I found myself thinking about, well, clearly the demand for the debt comes from the credit rating itself, although I wondered if maybe there was a bit of a dynamic in terms of, maybe it doesn't matter what the credit rating is. If there's demand for this company at all, then the companies can just keep issuing it.
Yeah, I think that the credit rating has some bearing on the demand for the debt, but it's more like correlated than directly causation linked. And that's because, there are other factors like investors are looking at the credit rating as one measure of the financial health of these businesses, but they're also looking at a number of other factors. It's similar to like how you would evaluate an equity analyst report perhaps on a company. And I think that supply and demand dynamics are a really big factor here. Like if all these companies continue to issue more and more debt and they eventually flood the market with supply, right now we're seeing that there's a lot of demand for this hyperscaler debt. Like all these debt offerings have been oversubscribed. They've, been able to raise the amount of money that they want to raise, but it's possible that if they flood the markets with so much debt that picture changes. And there's also the possibility that investors end up seeing the underlying credit health of these businesses quite differently from how the credit ratings agencies are seeing them. So I think there's a lot of different ways that a potential cost of capital increase on the debt side could flow through to any of these three companies. But I think credit ratings are a really big, meaningful indicator that investors are going to be looking at.
Great. Anita, I want to thank you for coming on. That is Anita Ramaswamy, our financial analysis columnist here at The Information. Another defense company is raising another big funding round. Saronic is raising up to $1.5 billion at a $7.5 billion valuation in a funding round that Kleiner Perkins will lead. That is according to an exclusive report from my colleague Corey Weinberg, our Deputy Bureau Chief of Finance. I want to bring on Corey to talk more about this deal. Corey, welcome back to the show. It's great to have you here.
Hey, Kosh.
What is Saronic? I never heard of this company.
Yeah, Saronic, well, if you haven't spent a ton of time sort of in the trying to come onto the shores of the United States, then maybe you wouldn't have swimming in our waters here. No, I mean Saronic is a naval ship company. They are quickly becoming one of the best funded startups in defense tech. And essentially what they do is that they build sort of warships and naval vessels and try to sell them to the US Navy.
Okay, but you said in the story these are autonomous warships?
Yeah, they're unmanned generally. So Saronic is bundling sort of their autonomous software with the ships, and that's sort of a big future priority for the U.S. Navy.
Okay, and so the U.S. government, are they the only customer for Saronic right now, or who are they selling to?
They're the only significant customer, to my knowledge. They, I think, aspire to also sell like a lot of sort of defense tech companies to U.S. allies. Sometimes that's easier said than done. Countries tend to want to sell, or excuse me, to buy technology from homegrown companies. So that can be difficult, but they aim to sell to U.S. allies as well, and they also, could have a commercial, sort of could sell their software commercially at some point down the road. And they might need to. I mean, they have a big valuation now. It's potentially up to $9 billion.
And what do we know about the revenue profile for the company?
We reported in the story that they generated just over $200 million in revenue last year. So that's it's fair to say investors are expecting a hefty amount of growth in the coming years, and if they don't get it, then Saronic will look wildly overvalued. Because that's a pretty significant multiple, at least if you're looking at the previous year. But look, these are really big ships. They're trying to sell them for a lot of money, and investors are betting that the Navy's going to buy them.
Okay. So, one of the interesting parts that you had in your story is that Kleiner is leading this deal. And is Kleiner a big defense tech investor? Is this a practice that they're building out? I mean, is this a trend that we're seeing that VCs are starting to build out these practices? Because I can only imagine how much technical expertise must be required for an investor to understand any of this.
Yeah, it's really interesting, Akash. Kleiner Perkins hasn't done a major defense tech deal before. This will be out of their growth fund. So it's designed for later stage companies. Kleiner Perkins has invested in Flock Safety, which obviously sells sort of license plate scanning cameras to police departments, but slightly different than defense tech. No, I was surprised. We had been hearing about this round for at least for weeks that Saronic was out there trying to drum up interest. And I personally expected either one of the VC firms that has really, sort of put defense tech front and center of their whole message to kind of go out and try to lead this round, like an Andreessen Horowitz or Founders Fund or 8VC or something like that. So I was a bit surprised when Kleiner sort of was the one that emerged as leading it. But look, I think from what I hear from VCs that are doing these types of big deals is like, why would I invest in, why the third AI, coding startup right now, when they might not exist tomorrow, sort of, and I think folks are looking at companies like SpaceX that have built, monopoly-esque businesses over a long period of time, they see a hardware moat. They see, hey, it's like expensive to build these companies, but once you do, it's pretty sticky. So I think Saronic is, it makes sense why a firm like this would bet on them, but it certainly, you know, uh, I wouldn't be that surprised if in 5 years I'm back on the show talking about the, sort of cautionary tale of Saronic as well.
But I mean, let's go back to sort of expertise. I am curious, the people you talk to, the people at these venture firms, I mean, is it the same group of investors that were investing in, I'm not calling them low tech, but, software companies of, 5, 6 years ago? Have they sort of expanded their focus area, or do you have people who actually have backgrounds in the military or in building warships that are now coming on board to these investment companies to offer their expertise?
Everyone will say they've done really strong diligence, Akash, on these companies, no matter what. No, look, I think that's one of my major questions as more capital comes into the space is like, as an investor, do you know what you're buying? Do you know how revenue is actually going to flow and whether this company is going to be able to sell their product, across enough customers that it's going to turn into a meaningful business? I mean, look, I think VC firms are increasingly tapping advisors who have been high up in branches of the military or the government. Those linkages are probably stronger than ever. But yeah, I think the investors, particularly that have been doing defense tech for a while, will look at some of these deals done more by generalists and say, I don't know about this one. So, I mean, that's something to watch going forward. It's not necessarily sort of explicit or directed just at Saronic. I think people have opinions on this company, and some people are really bullish. Some people think the valuation is ahead of the traction. But look, I think VC firms uh, are used to sort of following the herd to some degree, and also accustomed to making bets that they can sit in front of their investment committee and defend. And so, I think this one might be like right on that edge.
Well, I love your cautious uh, analysis of a business like this, Corey, because like you said, it seems to be very much a sign of the times. But at the end of the day, who knows, really?
It's
Uh,
interesting. I like writing about these companies more than the 10th coding startup.
well, I mean, maybe just sort of get your temperature on this. I mean, where do you think this sits on the fence? Are you sort of looking at this, being like, I don't know about this one, guys?
I mean, I don't know enough. I haven't seen, the ships in action, or like, I haven't talked to a naval customer yet or anything like that. It's unique. I think Anduril is kind of a company paving the way here in terms of, companies that um are capital intensive, burn a ton, and are trying to sell big, sort of weapons and war machines that are quite expensive to manufacture and expensive to buy. So we'll see. I think it just like might take a while. I think with all these companies, I think if it's going to succeed, it's usually on a slightly longer time horizon than investors are used to.
Great. Well, Corey, I want to thank you for coming on. That is Corey Weinberg, our Deputy Bureau Chief of Finance here at The Information. Robot data startup Encord is raising $60 million in new funding. That is according to a new exclusive story in the Information's AI Agenda newsletter. The problem of training robots with more high-quality data is one that is becoming increasingly important. I want to bring on the co-founders of Encord, Ulrich Stig Hansen and Eric Lando. Ulrich and Eric, welcome to the show. It's great to have you here.
Thank you.
Thanks for having
Nice to be on.
us.
You guys could have your own TV show, Ulrich and Eric. It has a nice ring to it. What do you think?
That's why we got together.
For the TV show or for the robot data startup?
Just for the
company?
names. Just for the names. It's good name running.
Great. Okay. Well, I'm going to start with you, Ulrich. What is Encord? Tell us about the company.
Well, Encord is building AI native data infrastructure. So we work with more than 300 of the world's top AI teams that are building different types of AI applications, everything from autonomous cars to delivery drones to surveillance cameras and everything else in between. We generally work with companies that are building, again, AI systems for the physical world. And of course, a lot of the robotics companies that are now coming out in the Valley, which I think is a super exciting place to be.
And Eric, you raised $60 million. What's the valuation of the company now?
We are over half a unicorn. I think we can say that. So
Over
maybe
half
the
a
first half of the unicorn. Yes,
Okay.
It's missing a tail.
it's missing the tail. Yeah.
Okay. All right. Well, hopefully you find it. It's all I have to say.
Next round, we'll put the tail on the unicorn. So no worries there.
Okay, so Eric, what I'm sort of hoping to get your clarity on here is what is good data and what is bad data in robotics? Because I think when we've been on the show, we've talked about teleoperators, I think they call them, right? We've talked about people going out with cameras themselves and kind of like Google Maps, collecting as much data as they can. What distinguishes what good and bad is in this arena?
It's a good question, and it's actually very use case and context dependent, and it's something where we're actually discovering what the frontiers of quality data is, and a lot of the labs are trying to do this research to understand what makes their data actually important for their models. I think there are a few principles that you can follow. One is that you need diversity of data, and one of the issues that people have with some of the data collection that they're doing is that they're getting a lot of redundant, repetitive data. So it's not mining the different failure modes and edge cases that these models can see, and that is like one of the big bottlenecks that a lot of the labs have at the moment.
And when you say incomplete data, what do you mean by that?
So you might have a lot of data of you in good lighting in your room with a robot making your bed. But let's say that it's stormy outside, or you move your bed position. Then the robot has never seen that particular context of data. So while a human can generalize, and we know how to kind of operate under multiple conditions, these AI systems, they don't have the intuition. And so when you don't have the right data conditions in the training environment, then the robots will fail in areas that are relatively trivial from a human perspective.
But basically, what I hear you saying is, if this is a matter of someone taking a video as training data of a certain environment, I mean, you have to get every angle, every
Yeah.
corner. It can't just be the 2 or 3 shots and hope
That's right.
that they get an idea.
You need full coverage.
Ulrich, what sorts of robots are we talking? Who are the customers that you're selling to?
We've seen a huge proliferation in different types of robotics applications over the past couple of years. I think the one that stands out the most has been the humanoid form factor. So there's been a huge number of companies that have started in the last couple of years with building robots that will go into your house. They will go into the warehouse. They will go, farming the fields. And they're building these humanoid form factors because they kind of fit the existing human workflows. So they kind of slot well into the current set of roles and jobs that we're doing as humans. So that is most of where we're seeing the growth today. We also do work with companies that are building different types of warehouse robots that are doing things like stacking packages in warehouses or delivery trucks. It's really any robotic application that we see a human or previously an industrial robot taking on.
And so when you sell your offering to one of these companies, whether it's in an industrial setting or a humanoid setting, what exactly is the service there entailing on your end? Are you going out and hiring a group of people to collect this data? Are you simulating it? How are you doing it?
Yeah, that's a great question. So I think it's good to ground ourselves in where robotics is today. So with robotics, we don't have the luxury of having an internet that we can do pre-training on, like we saw for the language model a couple of years ago. So a huge part of what our customers are doing, and also what we are helping our customers do, is collect the right data for the model. So that goes into the pre-training step. And of course, the models are trained and they start to learn how the world actually works and build a representation of what that looks like. Then once the data is collected and the model's been pre-trained, then you go into the post-training step. So for the post-training step, that's what you generally like look at things like annotation and alignment. You kind of look at the model's output and start to grade it. Our software helps our customers with building that complete flywheel basically from day one. So they go and they get all the software and all the services and everything else that they need to build out their robotics foundation model, their robotics, humanoid or whatever else it might be. We are also starting to see our customers shift into actual deployments, which is very exciting. I think these things are rapidly advancing and coming to market. And we, of course, also are helping our customers complete the flywheel by supporting them with the post-deployment steps. So once the robot is going in and it might be like emptying your dishwasher or whatnot, we have a team that helps with the teleoperation of the robot. So effectively like steering the robot as it gets things wrong. We kind of call that exception handling. It's also a big part of the software that we offer, and that completes the whole pre-training to post-training to deployment flywheel. And we again help our customers at every step of that journey.
Right, but Eric, I mean, help me understand here. So you have the software, but do you not have a team of humans that you've contracted to physically collect that data for the customers too?
Yeah, it's a combination of both. And actually, to get the right answer for this, you need to both have the operations and the software platform. Because what we discovered is that just having one is not really sufficient to cover the full data stack for physical AI.
Got it. Tell me, I'm curious about how you seek to differentiate yourself. I Rocket Drew, the reporter who wrote the exclusive story about you guys today, he mentioned in the newsletter you're building a giant warehouse with the money where you're going to collect all this data. I imagine other companies are doing the same thing. What's different about you?
Well, I can comment a bit. One is that we spent the last several years first building the software platform. So to do that, you have to build scalable infrastructure to handle petabytes of data. And that's what we spent the last 5 years doing. So we spent a lot of time doing our own architecture, working with multimodal data. And now we have a bunch of customers that use our system at scale, which will be a huge advantage once we get the warehouse completely fully up and ramped.
Great. Ulrich and Eric, I want to thank you both for coming on, and I look forward to tuning into whenever this TV show of yours debuts. I'll be your first viewer, that's for sure.
Next time we'll send our robot avatars. So
There you go. You have to come up with a name for the robot as well. All right. Well, thank you to you both. That is Ulrich and
Thanks for having
Eric,
us.
the co-founders and co-CEOs of Encord here on TI TV.
thank you.
That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank you all for tuning in. We really do appreciate your viewership. Make sure to subscribe to the information on YouTube and follow us on X, Instagram, TikTok, and check us out wherever you get your podcasts. I'm already excited for our next show tomorrow. Have a great rest of your Thursday. Bye-bye for now.